Dale, you have your interview?
Yes.
Mr. Blanchflower is here. Excited to hear Danny Blanchflower.
Can you hear me?
Oh, there he is. All right. Well, then I'm going to turn it over to Dale. Thank you, team, for being here. K-Man, Stelios. I didn't see Steve around here, but and thank you, Dale. Have a great interview with Mr. Blanchflower, and I'll talk to you guys soon.
All right. Thank you, team, for making a lot out of not much this morning. So, Danny, welcome back. Welcome back to F.A.C.E, Danny. Great time to have you.
Of course, as I said on Twitter a minute ago, about to go talk to my pal Dale.
All right. Well, that's great. You want to show your mug on this interview? And I'm also... No? Okay. All right. I want to at least put up...
it's a little early here.
Okay. I understand. I want to show what we're going to be talking about today. And for those of you who don't know Danny, he's a professor at Dartmouth. He was on the MPC, excuse me, during the last Great Recession. And he's a labor economist. So his heart is with the working class and how difficult it would be if Fed policy made errors, which he believes they're doing again. But you know what, Danny, I'd like to start with this because I've tried to explain this to myself, to traders, to friends. How did we get from a massive unemployment problem that we needed to support during COVID, all of those millions of people, and unemployment, for a short period of time, went to 14, 15%. How did we go from that to having a labor shortage that they call the Great Resignation? Where did everyone go? I mean, did they use their government checks and they made money on crypto or meme stocks and they're retired? Where are they?
Well, some of it was, two parts to it. The first part is that the supply chain really bottled up, not least because people were forced to be at home. So it was really very difficult to make cars and transport things and so on. So this is basically a supply side problem. But then people essentially were sent home. Some of it they were given payments to stay home. There were furlough payments, but a great deal of it has to do with fears of COVID. And here I am teaching at Dartmouth, and we're back to 2.5 years in, and cases at Dartmouth have tripled in the last 3 days. And so people are fearful. I mean, people are fearful of what's gone on in this world. I think the argument that always gets to me is, they call it the Great Resignation, and people have resigned. But so there's been a big increase in retirements, but there hasn't been a commensurate rise in Social Security claims. I take the sense that a great deal of this is about people doing this for now. They're worried, particularly women are worried about they've got kids, they're worried about going back to a workplace where people have got COVID. And this COVID crisis sure as heck isn't over. So I think it's that. I think people have also realized the value of their leisure time is higher than they thought. Leisure time in the sense of home, looking after my kids.
Instead of 2 hours in the car commuting.
Yes, I think that's right. I think, and there were Danny Kahneman, who won a Nobel Prize in economics. He has a paper which shows it's a study of 1,000 professional women, and they were asked, what was the thing that made you the most unhappy of all things in your life? And the answer was commuting. So people have sort of revalued things. So that's what's gone on. Remember, when we say that, everyone says, the labor market's tight, it's abject nonsense. If you look at the employment to population rate, that's well below what it was in 2020, well below what it was in 2008, and well below what it was in 2000. So what's happened is that people have withdrawn from the labor force because essentially the job wage offer is too low compared to the alternatives that they're doing. So there's an adjustment problem going on, and people are sort of rebalancing their lives. So that's what's happening. Some of it, actually, we see these wage increases. Some of it, what we know is that around the world, people who were on furloughs, they were on 80% of salary, have now come back out of that. And the wage increases we're actually seeing are about people going back to their normal wage. They're not really wage increases, they're just readjustment. So I think the answer is that we're still in disequilibrium with an economy adjusting. And now what we've got is We've got new waves of COVID, and 1 in 13 in the UK have got COVID. And we're seeing a war. And so we have to look to sort of historical perspectives and get realistic. And this inflation is not driven by central bank action. The action was driven because of a huge negative shock to output.
Okay, that's different. I mean, there are a lot of people, scapegoating Paul, saying he stayed easy too long. I know you were a proponent of, you felt comfortable knowing that Janet Yellen, who got Ben back on the team when they sang Kumbaya, and then after the COVID shock that they came in with bazookas and
what else could they do, Dale? What else could they do? I mean, really, what other option did they have? None, right?
Right. And so, I mean, there are still guys out there saying, well, they predicted that if all this fiscal stimulus came in, that it would just create too much demand during the supply shock.
Dale, the thing in a way which gets me about that, and the column which we're going to talk about that I wrote today, is kind of relevant to this. So if you go around the world as I do, and there's a great data release I had from the OECD this week, everywhere in the world has got this problem. Turkey has a 50% of inflation. Italy has it. Spain has it. Ireland has it. Everywhere in the world. So how do you explain that? Presumably, what the Fed did, or what happened in the United States. I mean, obviously the biggest economy in the world, but this isn't a Biden problem. This is a global problem. We've had a global pandemic, just as we had a global financial crash in 2008. So for anybody to argue that this is just about what happened in the United States is an idiot. I mean, that's just simply nonsense. How do you explain that it's true in every other country in the world? Because there's something global going on, and it's called a global pandemic.
Right. Okay. Point well taken. And when we wrap our COVID discussion up with the way China is handling it with zero tolerance, your view on that. The U.S. has put out travel advisories not to go there, or Hong Kong, that for sure you're going to be in a government installation, quarantined for 14 days. This is going to have an impact on the global economy.
Yeah, of course.
China's economy slowing.
Well,
right?
Of course, with the shutting down that we're seeing there. I mean, I just think, in a way, I've said to you on this show many times, this isn't over. We don't know the path of this thing. And of course, people can, and I've always quibbled with people saying the Fed is going to do X numbers of rate. How do you know? Guessonomics. The data is going to be crucial here. We don't really know what's coming. And the paper I've written just talks about the fact that essentially we have two data points. We have a data point from 1914 through 1929. Where a giant shock, a pandemic, a financial crash came. We have data from 2008, and we have data from today, and that precedent is problematic, and much is going to depend on the data. Much is going to depend on the data that we don't really understand. And if you think this baby's over, you're foolish. And so it's proved. And I think that what we've gone to, and I've said it to you several times, this is guessonomics. I have no clue what's coming. The Fed doesn't really know what's coming. We will have to watch the data. And the plausible position is A, there will be no rate rises, and B, if this thing continues, there may well be rate cuts. I wouldn't rule that out. But anybody, I mean, all these financial institutions saying there'll be 5 rate rises by whenever it was, they're just making it up. They don't know. We'll wait to see what happens in the data, and the data are not good. Okay.
What do you say to the economists that say that consumers are still in good shape? They have great balance sheets. Their houses are worth 100% more than what they paid for it. Their IRAs have come back. They're doing okay. That they have they're claiming that consumers have good balance sheets, but at the same time, we were talking about the increased use of credit cards now, that perhaps people are starting to live on credit.
I mean, yes. I mean, obviously, I think one of the greatest puzzles that has existed has been, if you read the economics literature, a shock comes along, and what you expect people to do is to do precautionary saving so that they have a buffer when the next shock comes along. So basically, the surprise has been people basically haven't done that. They've spent like gangbusters. But what we've seen around the world, yes, you may say that they're in decent shape, but the evidence is that consumer expectations and confidence around the world have completely collapsed. So predictive of recession in the United States is the fall in consumer expectations, both in the Conference Board and the University of Michigan, that tracks almost exactly what happened in 2007. In the UK and in Europe, we've seen collapses in various measures, particularly the fears of unemployment measures, which are predictive of big jumps in unemployment. And the ECB sensibly basically has been following that. Things are rising, unemployment's coming, and will not raise rates this year because that is predictive. And I think you're showing this chart. You're showing this chart.
That's tomorrow. What's Lagarde going to say then?
Well, I think they're going to have to say that the fear of unemployment has risen a lot. We're going to wait and we're going to watch, and we're fearful of what's coming. I mean, look at that picture.
Yeah.
So this is a picture, and I think it's indicative.
It's worse than the bottom of COVID, and that it didn't last so long. But
this is so actually during COVID. So this is the UK, just a survey in the UK from 2012, and it asked, and we had the same things around the world, and they collapsed everywhere. But here's a little typical one. So this is during COVID, things weren't that terrible until you get to about March 2021. So that's a year in. You know, things dipped, but they got better during 2021. So that is British households' views of their financial prospects in the year ahead. And any measure you take around the world, it looks like this. It's dropped off a cliff. I mean, what's interesting is it didn't happen during 2020 because people's finances were protected by government action. So, and in a way, the fear that I have, and it's sort of back to the things you were talking about earlier, if people think the share price of company X is going to fall, it's going to fall. And if people think the economy is going to tank, that means it's going to tank, because despite what you said to me that people are in good shape, it appears that their consumer confidence levels have tanked and they think everything's going to get horrible. So why would people spend like crazy if they think everything's going to get horrible? Every expectation is that everything's going to get horrible. So
they say you can't get an airline seat, and hotels are booked.
Well,
is this the consumer's last hurrah? Is it the last hurrah this summer?
Well, I understand that, but there are bottlenecks. There are supply side bottlenecks. But an example is that we've obviously seen declines in production, the availability of stuff. I mean, the airlines got rid of all their planes, so they just don't have enough planes, right? But the other part of it is, in fact, around the world, the reason you can't get an airline seat is because the crews are all checking out with COVID. And so that's the reason they can't fly, because they haven't got a crew, or in combination with the weather. So this is about COVID. It's about people's views on the world. It's about supply side shocks and a central bank that can't really, I mean, it can't fix the inflation problem. Well, it can. It can fix it by causing a giant recession, which looks like that's what's happened, because the financial markets have done the job for the Fed by fiscal tightening that, in my judgment, is going to generate a recession.
Okay, I just want to talk about what you had the last time we talked. You had a happiness index.
Yes.
And it showed that we were headed this way. Certain states like California, people were already very pessimistic. I believe that was before the war. That was before another wave in COVID.
Right.
So I guess the news that you're making today is most economists that are even, concerned are saying, well, yeah, because of Fed policy, we could be in a recession in the next 12 to 18 months. And you're saying it's pretty close to right now. We're there.
Well, I think if you look at it, so the column that you're looking at links to the technical papers that we did. Right. The best analogy is there's two parts to it. The first part is that we don't really know when we're in recession at the time. So look back in 2000 and at the Great Recession. So the Great Recession was called in December 2000 as having started in December 2007 by the group. We basically say to them, you call this thing. So it's the NBR. I'm a research associate at the NBR. The NBR Business Cycle Dating Committee dates the start of the recession. In the US, they dated December 2007 in December 2008. So it took them a year. And the problem at turning points is that actually data gets revised and it gets revised downwards a lot. So the problem is we don't know when we're in recession, right? That's one of the big problems for policymakers. So if you're in it, it's probably going to take a year for you to work out that you were in it. But the data that I talk about actually predicts it between 6 and 18 months ahead of time. And it's never got it wrong. So these data are predicting entirely consistent with where we were in 07, that we're probably in recession now. Well, maybe untrue. It may be the first time out of 7 that it's got it wrong, but it's predictive that you don't know when you're in recession. It takes a while to know it. The worry is that you behave as if you're not in recession. And I think the evidence appears to be that the UK is headed for recession, Europe's headed to recession, and probably the United States is as well, based on any forward-looking data that we have. Now, other people can say that's just not true, but these data predicted it in 2007 and 8, and all these commentators and all the central banks and everybody else got it wrong then, and they were saying the same thing.
Yeah, I really love this paragraph up here, Danny, where you give people a little historical background of how history doesn't exactly repeat, but it rhymes. But here,
I actually wrote that, Dale. I wrote that. I actually first off wrote history. It doesn't repeat itself, but it rhymes. And the editor said to me, "Danny, do you really think it rhymes? Don't you think it's just repeat?" So I took out. Yeah. I took out that bit that I actually initially wrote that, and I took it out and I wrote, history, it seems, does repeat itself.
Yeah,
it doesn't even rhyme.
It's exactly the same sequence.
Look at what you got there. It's an amazing two sentences. The Great War, an influenza panic and a pandemic and a financial crash, which started in the Florida housing market, occurred over a 15-year period. And then we get a crash that started in the Florida housing market, a pandemic and a war on the European continent. That seems like precedent, right? So we look back and we say, what happened? And what happened was that people underestimated how long the pandemic lasted for and the effects of it. I just think the danger is that you make stuff up. I mean, look at the quote, a famous quote by Mervyn King, was asked in September 2008 what he thought was going to happen to unemployment. And he says, so if you go to the top, Dale, go back to the top. Yeah, so the governor of the Bank of England in September 2008, we now know the UK economy had been in recession since April 2008. And they said to him, just go down a little bit. They asked him, what do you think is going to happen to unemployment over the next year? And he said, I don't think we really know what will happen to the unemployment. At least the Almighty has not vouchsafed to me the path of unemployment data over the next year. So the governor of the Bank of England had absolutely no idea the economy was in recession and that the unemployment rate was going to rise. He actually also said, I was sitting 2 seats from him, and he also said he may have told Danny. He actually was, anyway, I didn't put that in, but he literally said he may have to Danny, because if you go back and read 2 questions earlier, I lay it out very nicely, and I say unemployment's going to rise. And it turns out unemployment rose from 5.2 to 7.9% over the next 12 months. So if the governor of the Bank of England has to appeal to the Almighty, has absolutely no idea the economy's been in recession, no idea the US has been in recession, then we should worry about what people say, what the markets say, because they all went along with this, and what policymakers say. If the governor of the Bank of England has no clue whatever, and the danger is that you get overtaken by events.
Yeah, like here, all the signs that another recession is on its way in 2022, yet policymakers have missed it again. So what data do you think would get the Fed to pause? Would it be a big break in
the data that I've talked about are what I call the data from the economics of walking about. So
is that your YouGov's index of households?
Yeah, that's the YouGov index. So the example of what do consumers say, what do firms say, what do the purchasing manager indices say? Of relevance, of course, to the Fed is what's happening around the world. If Europe and China look like they're weakening, that's relevant to them. But I think that the answer is that they have to be very cautious to focus on things. They want to focus on things that are timely, like these surveys, that don't get revised, and they need to worry about looking at GDP numbers. They'll get revised forever. Unemployment rates are not nuts. look at what happens to the labor market, but those are lagged indicators. They don't move much until after the recession has started. So the careful thing is look at the precedent for 2007. So what happened in 2007 was the housing market then moved to consumer confidence. Then it moved to real measures like retail sales and so on, and then eventually moved to other stuff, to the labor market things and so on. So I think the answer is you look back to precedent, you look at what happened in 2007, and you say, are these indicators moving? And get into your mind that inflation is temporary. Inflation, everything we've ever seen in the history of inflation, it's spiky, and inflation comes and inflation goes. And the danger is that for anybody who says the Fed should raise rates and so on, what they have to understand is that that has consequences. That has consequences for output. And the question is the solution to your inflation problem something worse?
Right. Like, how do interest rates affect the supply and the yield on crops?
They don't. They simply don't. I mean, the reality is that we're probably going to see warfare in the southeastern Ukraine, which is one of the great producers of wheat.
Yes, wheat.
That's going to impact the price of wheat. But what's that going to do with the Fed? One of the other things, Dale, I've seen is that the cost, the shipping costs, the freight shipping costs.
Oh, Baltic Dry Index.
The Baltic Dry. I write about the Baltic Dry. If you go look at the Baltic Dry, since the beginning of March, I mean, who knows exactly what's happened, but the Baltic Dry was the index that collapsed from May 2008. This index is at relatively low levels now. Whether you take it seriously or not, it's down about 30% or so since the start of March. So I'm looking at these indicators that told us about recessions coming, and I'm fearful that people do not understand the consequence of a rise of what happens if you get rid of inflation. So the story that I've worked on, I always have in my head a 1 percentage point rise in inflation compared to a 1 percentage point rise in unemployment, which is maybe what you'll create by trying to slow inflation. It's 5 times worse. So a rise in unemployment, it's in well-being terms, how people feel, is 5 times worse than a rise in inflation. So you better be careful what you ask for. You say the Fed should be raising rates, but it has nothing to do really with the causes of inflation. And what you're going to do is you're going to push the economy into recession. And that looks like what the markets have done, because they've generated, tightening across the yield curve.
I've never seen a bond collapse like this, maybe since.
Why do you think, Dale? Why do you think that's happened?
Because the Fed stopped buying, and there's not a lot of people coming in to replace their buying.
Right. And so listen, think about what that's going to do to confidence. I mean, there's another story I like, but I don't like. In the UK, the survey of the Institute of Directors, so that's a group of bosses of companies, and their index in March collapsed. So the question around the world is, is consumer confidence collapsing? What about business confidence? If that's going to collapse, that's recession, because they're not going to hire people, they're not going to invest in things, and investment started to look weak as well. So really what the markets are doing is they're really trying to bite off the hand that feeds them.
Okay, so we're in the midst of a sovereign debt crisis possibly here. Let me ask you this, the market and narrators aren't really talking much about what's happening with the potential for a Russian default, which was a big deal many years ago. And there was a recent default, I believe, in Indonesia.
Yep.
So we're starting to have these things occur. Is it a big deal if the Russians default on their debt like it was in, I think, 1997?
Well, I always like precedent, right? So where are there examples where a giant country defaults? And where are there examples of what happens? So what you just illustrated is, I mean, I always think collapses in financial markets have huge effects, have ripple effects around the world. There aren't really any examples. I mean, what you said, I think, was hugely sensible. The question is, do we have examples of financial crises that don't have lasting long-term effects? I mean, you asked, is this just a no deal? I think the answer is, any precedent we look to suggests that it's likely to be a big deal, right? A major country defaults on its debt. That's going to presumably impact trade relations. and trade relations around the world. I mean, again, this increases uncertainty because Dale and Danny don't know what this is going to do, but they don't think it's good.
Right. And European banks probably have more exposure.
Presumably, they have more exposure. Some of the reasons why presumably Christine Lagarde is very concerned. I mean, I look back and think about what happened in 2007, 8, and 9 when British banks, RBS and Lloyds fell. What were the implications of that? That, I think, was where they were rescued, but the biggest implication was that. And then there were European banks that failed, and there were European banks that were tied. I mean, there were the German banks that were tied to subprime loans in Detroit, right? And so what we didn't really realize, I mean, I remember Gordon Brown. Sorry?
The tentacles of debt.
Yeah, the tentacles. I mean, Gordon Brown, I think, famously said this. He said, what we did prior to 2008 is we tried to simulate what would happen to a single bank failing or a single country defaulting. He said, what we didn't do was to simulate what would happen if the global financial system went down. So it's the tentacles, right? Nobody quite realized, and should have, what happened. I mean, so back in 1926, the Florida housing market collapses because of a giant hurricane and the end of a boom. But then it's 1926, and then people start to default on their mortgages and on their loans, and that generates failures in the banking system. And eventually it spreads, and it leads to the great crash of 1929, which has implications all around the world. So I think that this is. I mean, we're talking. What does globalization mean? It's what you said, Dale. It means there are tentacles of everything everywhere.
Best advice you give the man on the street to prepare for it? Is there really any way to prepare for what we see ahead?
Well, I mean, I think that I do think that people are fearful. I think they're hunkering down. If you say your financial prospects are weakening, I mean, in a sense, that certainly looks realistic. I mean, I have the sense in the work that I've done is in contrast to economic forecasters, people actually have a pretty good idea what's going on in the community in which they live, and that's obviously worrying for them now. Yes. I mean, it's hard to know what's coming. Confidence in central banks, and think about confidence in government. I mean, in the UK, we've seen the Prime Minister and the Treasury Minister being fined by the police yesterday for illegal behavior.
Right.
The confidence people have in their leaders in a time of war. I mean, and what's happened in the UK is the Treasury Secretary raises taxes, and now there's a huge, not just about him being fined for illegal activity, but they found out that he had non-dom status, hadn't been paying taxes, even though he raised taxes on himself. So the confidence people have in markets and leaders and so on is really plummeting. So I think we have and obviously the story in France where you just had a discussion about whether Le Pen is going to win, but the support for Le Pen presumably doesn't come because people think everything's going great, right?
Yeah, that's interesting. So, everything's confidence, consumer confidence,
yes.
confidence in our leaders.
Yes.
And I heard the expression once, Danny, the difference in confidence is knowing what the con is.
Yeah, and there's another one like that. So in economics, right? So economics and econometrics, who put the con in economics? Economics, who put the con in econometrics and no, exactly. Yeah. And what people are realizing in many ways is they shouldn't believe what the experts say, and that's a great deal of what's gone on, right? They shouldn't believe anything these people say. And that in a way is dangerous in markets, and it's dangerous in politics, and we need to worry about it. But to actually argue, you have the faintest clue what's coming, which is what I hear in financial programs all the time. And I listen to, company X says the Fed's going to do this, and it's like,
right,
you have no bloody clue.
Well, Paul doesn't know.
What?
So how would they know? Jay Powell doesn't know.
Right? Absolutely. Well, Jay Powell doesn't know. That's why Powell and Blanchflower tend to be pretty close together in a sense that, he gets pushed around by what the markets are saying. But basically, he says, we don't know what's coming. We're going to go and look at the data. I mean, I thought Brainard's speech this week was moved away from that, saying, it's clear we're going to tighten. Well, okay, how do you know that?
And she's a dove. Yeah.
Well, she's a dove, and if the doves have moved in that direction, but I think mindful, and we should be talking about, I think in a sense what's coming is that the Fed and commentators are going to be hit very hard because one of these days, some really bad data, and shortly, some really bad data is going to come. And then that's going to knock their socks off.
Okay. Maybe it'll be an NFP.
Yeah,
So,
right. Well, exactly.
Like
but that tends to lag a little bit. But I suspect we're going to see some really bad data, and that's going to make markets suddenly go, oh, goodness me, they're going to have to reconsider. I mean, it could be that, maybe we'll start to see these inflation numbers coming down, the producer price numbers, but eventually the consumer and business confidence data lead into the real economy and real data, and that's what's going to scare people senseless.
Yeah, they will not be spending.
Correct.
And, I thank you for spending time with us today, Danny, and giving us your view. And another call, you're ahead of the game with your happiness index, and
Thank you.
The weakest countries right now, you're saying is Sweden, Portugal on your YouGov's index. So,
they've been hit really hard, and what's happened in these countries is in March, the expectations of unemployment, what's going to happen to unemployment in a year's time, has exploded across Europe. People think we've never really seen increases like this. They think unemployment's coming, and the question is, what's behavior going to be? And it ain't good.
And we'll leave it with that. Everyone's warned. Do what you can do to prepare for it. And Danny, thank you so much.
Of course.
Love talking to you, buddy.
You too, buddy. Thanks.
All right. That's it. Danny Blanchflower, and you could follow him on Twitter. And his writings are ahead of the time. He's ahead of the curve. And
thank you.
It was great to have him.
Great.
So everyone, adios. Have a great day. You could join the team in 12 minutes on the Morning Edge. And remember, no matter what economic conditions are, don't just count your pips, count your blessings.
Yes, sir.
We'll see everyone tomorrow. Adios, Danny.
Yes, sir. Thank you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.